Would you? And that's for me.
What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Mitchell Sneddon, how you going, mate?
I'm good, Owen. How are you, mate?
Very good, very good. I can see that there's a good amount of convo going on already. Jenny's in there. We've got Succinct. I think I've got that correct.
I hate the fact that there might have been some thoughts that I'd be the person that was late for this.
Yeah, well, that's blasphemy. But Mr. Leftovers did say, carrying on the tradition of being fashionably late. Well, I'm going to give you an excuse right now. We just had the Australian Retirement podcast being recorded in this room that we're in right now, and they gave me about 90 seconds to get in here and completely rearrange the room. So I feel like I've got a good defense. But mate, it's absolutely great to have you on the Rask Invest live show. Obviously, you do the Monday show, the Rask Invest walkthroughs with everyone. Today, we thought, why not fuse them together?
That's
pretty good.
Two birds, one stone. Let's get to it.
Yeah, and we're going to talk about ETFs. We're going to talk about we're going to spend just a very little bit of time on how we've gone for the last 6 months. It's not going to be long. Then we're going to get into some questions as well as some themes. We've got some themes from this month and from this quarter. Questions like, when is the right time to use a money coach? Like, what even is a money coach? When should you use one? We've got questions like how often you should be dollar cost averaging. And then thank you to everyone. Just as a quick side note, next week, we've been kind of trying to get some things in place, but a lot of you have sent in your submissions for Nightmare on Collins Street. So you may remember last week we did a call out. If you've got some horror stories of like the financial markets, investing, pump and dump schemes, scams, fraud, we know it sucks, but send it to us because, you know, maybe a problem shared is a problem halved. We'll summarize them and tell some stories next week of things that can go wrong. So that's next week on the Rask Invest live show.
I'm going to put one in there, Owen. Any ASX company that buys advertising space on the New York Times Square's billboard,
yeah,
they're guaranteed to to be one to watch out for. There's quite a recurring pattern there that I can think of a few. That if they end up there, if they're predominantly with their big faces, predominantly there, then look out.
Oh yeah. Just had the mighty Drew Meredith just come in after he's forgotten his phone. So invading the studio yet again. There he is. But anyway, I agree with you, mate, because it's also the same for like individuals who put maybe their face on the Times Square. Maybe it's not a great thing. I remember what was that company that did like the music, the videos for small businesses?
I'm thinking of the exact same company. That's where I
Big
got
Unlimited.
Big Unlimited came unstuck in a very big way, and it was around the Get Swift days and all those kinds of things. We had a little run of those types of blow-ups, and Big Unlimited came really unstuck. And but the father-son combo, I think, featured predominantly on the New York Times. The Times Square, billboard.
It did. So we'll cover all that and more if you want some pretty shocking stories. That's next week. I'll bring up some slides, and then please obviously flick us your questions in the chat, or we can see them all coming in already. So good. Owen Boxall, good to see you, mate. So Rask Invest Live brought to you each and every week by Pocketsmith, Navexa, Super Guide, Perla, and Rask Invest, of course. So we've got someone from Perla locked in for next month. We've got Navar often in the chat. Pocketsmith, you might have already heard of on the podcast, so it's great to have them on board. If you haven't already subscribed to the YouTube channel, go ahead and do it now. If you're watching on Facebook or LinkedIn or something like that, the Rask YouTube channel is the place to go. It's where we all kind of get in amongst it and in the chat. We are going to talk about a couple of things today. We're going to talk about a lot of ETFs. We're probably going to talk about shares. We're probably going to talk about like just everything. Really important to understand, even if we do talk about your questions, we do not know your personal circumstances. So anything that you hear on a Rask podcast or here on the live show is strictly general in nature. The information that you get does not take into account your needs, goals, or objectives. So always consider if the information is appropriate to you. If you don't know what your needs, goals, or objectives are, let's be honest, a lot of us don't, speak to a financial planner. You can find legitimate financial planners on the moneysmart.gov.au website. Finally, if we do talk about things like ETFs, super funds, insurance, they all come with something called a PDS, tells you everything you need to know. Make sure you read it. Some of them come with a TMD, or target market determination. For example, Rask Invest, it's an investment service. It comes with a TMD. You'll find it on the Rask Invest website. So that's done. Rask Invest Live is every Thursday, midday Eastern time. Mitchell Sneddon is joining us. Now, I put 10 years plus of investment markets experience here. He said, you're doing me a service. He heads up our Rask Invest service as head of funds management. I don't know if people know this, Mitch. Your cat is nearly famous, but I don't know if people know it only has one eye.
Well, no, because it only just it kind of briefly brushes past the screen every time I'm on air. So there's every chance he'll come down, and if he does, I'll get him to face the camera.
And he loves going to the zoo. So these are the things that Mitchell likes to do, and that's a little bit about him. If you do want to tune in more and hear from Mitchell, you can hear from him every Monday at midday, I believe it is. Mitchell, if I'm not mistaken.
Midday Monday.
Yes. Okay. So today we do have a lot to talk about. We're going to be quick with some of the Rask Investy stuff because we know not everyone here invests with us, but we do think it's important. We've just ticked over 6 months. You can see the performance of each of our 3 different strategies here. You can see the total return down the bottom. That's the income plus the capital. Interestingly, when this number was taken, which was the 30th of September, we started on the 31st of March, but keep in mind that that's the end of that month. So keep that in mind. Most people didn't invest with us. And I think basically no one invested with us until April. I could be mistaken. So just keep that in mind. Past performance is not always a good indicator of future performance. But basically when we came out, Mitch, a few months ago, we basically said, here's what we expect. And I think that when we said, I think for Jupiter, our highest growth strategy, we said
scroll down a little bit, Owen. I think our noggins are cutting off the.
Yes, there we go. Thanks, Mitch. I think when we said Jupiter, we set it at 7.5% plus is our expected return over time, and obviously we're in line with that now. Things have been okay. Very short-term track record, only 6 months for us. But there was very deliberate reasoning of why we wanted to do that, because expectations are really important when it comes to investing, Mitch. I know you've got something to say on this.
Yeah, exactly right. I think I talk to a lot of people, and I've had some people I've spoken to very recently, and they come into investing with very unrealistic expectations, or they approach it needing very unrealistic expectations. I think that's a terrible place to start, because that leads you towards potentially the much riskier end of the market. Maybe also even gets you talking to some people who maybe don't have your best interests at heart and are selling you trading courses or options trading courses and things like that for short-term money. So coming in, having an actual understanding of what a realistic return. So just having an understanding of what the long-term average of the ASX 200 is, or a long-term average of the S&P 500, and using that as a bit of a baseline, which is essentially how we also came up with the target returns for these portfolios, seeing the combination of asset classes that we had, what the long-term returns over those asset classes over a full market cycle has been. Now, I always say to people to take annualized returns. They are the returns, but it's incredibly rare to see a fund actually hit, if its annualized return is 10% per annum or 9% per annum or something like that. It's very rare for it to actually hit that on the nose for a year. It's either overshooting that or undershooting it dramatically. But the long-term average, if you just continue to buy and hold for the long term, that is what you'll receive.
And that's the thing, like some years are good, some years are not so good, as someone might say. So you can see that here, right? There was one calendar year in 1983
Jesus.
when the stock market, in that 1 year, the whole stock market went up 66%. Imagine that was your first year of investing and how you would have felt. Second of all,
this stuff's easy.
yeah, then the next year it falls 2%. You'd be like, oh my gosh, what did I just do? And then it's up 40%. And then at 50%. Imagine that 4-year period of your life thinking, oh, this is what investing is. I'm probably going to average around about 35% a year. But one thing you will notice here is that over time, it's slowly, like the trend line here is kind of down. The annual return that we're getting from shares broadly is kind of converging towards that high single digits. And then if you mix it with some cash or even some property, which is also in the high single digits, you end up with a blended, diversified portfolio that's probably going to be somewhere in that high single digit range if you're doing a good job. Now, some stocks, some ETFs might do well at different times, but as you know, most professionals will tell you, if everything in your portfolio is going up at the same time in the same way, you're not diversified, because that's the whole point. Some of them are supposed to go down.
Uncorrelated assets.
Uncorrelated assets, that is it, Mitch. So if we move on, one of the things that people will want to know, I'll bring this up in a different way. One of the things people will want to know if you're invested with us or if you're not, you probably just want to know, hey, what are you guys invested in? And one of the beautiful things about what we do and how we invest is that we can just show you, and it's no major sweat, because by showing you what we invest in or even what we think we're going to invest in, unlike a fund manager, say, for example, that invests in individual stocks, we don't need to hide it. It's fully transparent, and anyone that can log in and see it, it's right here in front of you. And we don't share this with you so that you go and buy everything, but hopefully it gives you a short list of ideas that you can then go and pursue if that's really interesting to you. And you can see some things here. And the reason why the VanEck EMKT ETF is highlighted is because that was a recent addition. We took something out and put that in. But this will evolve over time. Think of this like a canvas. We've been going for 6 months. Over the next 3 to 5 years, we'll probably add a few more positions in here. We might take a couple out, but we're going to try and keep that turnover very low for these core strategies that we're pursuing. But that's basically it. We're happy to answer questions on that. And Mr. Leftover summed it up. Like the legend Gattuso once said, sometimes may be good, sometimes may be shit. I filled in the blanks there, Mr. Leftover, so you're welcome. But that's the truth. Raymond, you did ask a good question, mate. You said, please compare VTS to VGS. Which one will provide better returns or distributions? So really good question, Raymond. I think what will happen with these two ETFs, so just so people are aware, the first one you're talking about is VTS, which is only US stocks. It holds about 1,500 US stocks. This ETF, by the way, is US tax domiciled. So that's a really important thing to understand, is even though you invest in this ETF in Australia, for tax reasons, it's a US ETF. So that puts a lot of people off. It's one of the reasons we don't hold it.
It's not even actually available. I was looked it up just to confirm that it was US domiciled. So that's what immediately came to my mind. I just looked it up on the Vanguard site, and they actually don't allow people to. It's interesting that they don't allow people to invest in VTS via Vanguard Direct, the personal. So they realise the tax conundrum that it poses.
Yeah, so that's a really good point, Mitch. So that's why a lot of people don't invest in that, just for that simple reason. Now, VGS is not just US, it's global. And the other key benefit is that it's also tax domiciled in Australia. What that basically means is, from a practical standpoint, is you don't have to fill in the W-8 BEN form, the tax form, the US tax form. It also may not expose an investor to what we call estate taxes and estate kind of planning laws in the US, because effectively what you're doing is you're owning a thing that is taxed and controlled effectively from the US, even though it happens to be here available in Australia. And so we don't invest in that. And the reason that we don't invest in VGS is because we feel that we get better exposure by just being in the IVV ETF, the S&P 500 ETF. Over time, all three of these ETFs, I would suspect, perform similarly. The key difference between this one and the others is that this one obviously has Europe and it has some like Chinese shares and that sort of stuff in there, where the others don't. But that's kind of like the deliberate decision someone would make. VGS Global, IVV, US, knowing that a lot of the US companies are global companies anyway. They just happen to be politically and I guess financially regulated in the United States, which is a massive advantage for people that kind of believe in democracy and American exceptionalism and all that sort of stuff. But ultimately, performance-wise, maybe they perform similarly over the long term. That's not a forecast or a guarantee. It's just a kind of general gist of the market. A good question here from Huang, who says, will you add ethical ETFs in the future? So Mitch, maybe I'll throw to you in a sec. But the first thing to keep in mind is, Huang, yes, we are definitely considering it. Sound like maybe like a politician, but we have and we are actively considering this. We're also actively considering a kids portfolio. That's the first thing on our list. And the other thing that we're considering is how do we build the core and satellite functionality in? So these might be your core strategies that you see here in front of you. And then how do you add a satellite? So let's say, for example, you want a satellite that's like a distinct portfolio for health technology or, I know emerging markets like concentration. So people can like bolt that together with their core and it can give them a slightly tweaked exposure. I hope that makes sense. Mitch, ethical.
Yeah, we've had the ethical question posed to us a few times, and it is I wouldn't say it's difficult, but it's still a very immature market here in Australia for ethical ETFs. And as well, like when we are putting together a portfolio here for our core allocations, one real consideration is the underlying MER, the management expense ratio, so the fee charged by the ETF itself. And so we're looking, and so we want to keep that as low as possible. So for example, IVV, for example, the MER in that is 0.04% per annum. So any cheaper, they're paying you to hold it. But when we go and look at some ethical counterparts, that MER is still quite high. And so it makes putting together an efficient portfolio a little difficult. It's not impossible for us, but it is absolutely in our minds. It's just not the very next cab off the rank.
Yeah. So Huang, we've probably got like 4 or 5 things we really want to get to over the next 6 to 12 months. Like we think they're absolute must-dos for our community. This is probably 2 or 3 on that list. But the very first thing is we need to try and help parents and grandparents invest for their kids. That's the next hurdle, I'd say, Mitch.
Yeah. I would like to, we've been talking about the kids portfolio for a while, and where we are on the cusp of having it sorted out. Now, keep saying it's for kids, but it's actually essentially going to be an all growth portfolio. So I know there's a lot of people out there as well who say to us, look, I'm actually regularly saving. I'm adding money into a portfolio, or I'm regularly saving, so I've got cash. If they're taking a portfolio-wide perspective of what they're doing and factoring in their own bank accounts and term deposits they might have, etc., they say, "Hey, I've got my own cash component. I want an all growth. I want all Australian shares and international shares, etc. So I want to carve out the bond and cash exposure." That's the kind of portfolio that we're doing. I didn't really want to, when we were discussing the kids portfolio, I wanted it to be something that I'd be very happy to put my son into. And so what was a real consideration were, putting in their ETFs that I know are going to be around for the next 20 plus years.
Yeah, that's number one.
Because I do not want to have a tax event occur to me because of the tax rules around kids investing. I want to have as little transactions, as little rebalancing as possible. So I don't want an ETF that's continuous, like doing lots of rebalancing inside it. I want to actually minimize my dividend income as well, my distributions. So all these little things, we wanted to build a portfolio that was actually structured in the right way for ultra long-term investing, be it, someone who's just starting out investing in their 20s or 30s. They can come along if they hold cash on the side and are happy to add to the portfolio. They know they can hold this account for the next 20 plus years. And something that I talk to parents a lot about as well, and I know this in my mind, that when a child turns 18 and you can hand them the portfolio, that's not the end.
You hope not, anyway. You hope not.
Like, if that's the end, my communication with Will has gone bloody pear-shaped. If he's pulling that out and buying a car, there'll probably be autonomous vehicles by the time he's 18. He probably will never drive in his life. But I hope to hand it over and say, rightio, mate, it's yours now. Continue to hold that for another 40 years. And so that's really important. All these considerations have gone into it. What annoys me out there in our industry is that, yes, you can have kids accounts of anything, a balanced portfolio, a growth portfolio, but whatnot. And it's just, the structure is an adult as trustee for the child. But it's not a kid's account. Like, it's not thought about in holding for a lifetime.
Yeah.
That's what I want to get right.
So index funds, by their very nature, and we've spoken about this before, index funds by their nature are what we call anti-fragile. So a lot of people that invest for their kids invest in a structure and invest in something that doesn't evolve as the market evolves. Like, for example, we got Microsoft, Apple, Amazon, 3 of the biggest companies in the world right now. So if you invest in any global ETF or a balanced fund, it's going to have those 3 companies. But in the year 2040, is it going to be those 3? Maybe it's something else. And you have to have a way of holding those companies. And that's what makes index funds so great, is that as the new age companies come, they rise to the top of the index funds, and the Apples and those things slowly fade away. Even if they're still there, they just fade away. And that's the beauty of them. So it creates this structure where if Wilbur's 18, he's probably going to see Apple in the top 10, but maybe it's not number 1, maybe it's number 9. And then when he is 50, maybe he doesn't see Apple at all. It's disappeared, but there's something else that's taken its point. And that's the beauty of them. So yeah, one extra note here on top of this is that the portfolio itself has been approved by our investment committee. It got approved, was it this week?
Was it Monday?
Yeah, it's Monday.
Yeah,
so
Monday.
Yeah. So Karen, Gemma, Kate, and us 2, that was formally approved. So when we're ready, basically, to go ahead, some of you with the keen eye might have noticed that there's a different logo in this overall image. And I just realized it happens to be sitting right here on my shirt. There are some changes coming to Rask, and we want to kind of celebrate that in a few weeks. So watch this space. There might be a few new changes that we can talk about when the time comes. Now, we have more slides. Slides.
I feel like we got bogged down in a bit of a rant there.
We did. But feel free to chuck us your questions. Claire says, great idea as the boomer portfolios soon get handed down, and our gen then wonder what the hell we're going to do with it for the next. That is so true, Claire. Like, you have a lot of grandparents at the moment are trying to hand their kids BHP shares and hand them CSL shares. And the kids are like, what am I going to do with this? If you hand them something that's relevant now and can grow with them, sure, CSL, BHP, wonderful businesses, not going anywhere, let's be honest. And thank you, grandparents, by the way. It's probably the first thing you say. But how do you transition that to the kids? How do you teach them? How do you relate to them? Probably relating to them with CSL and BHP is not, unless they're miners or in biotechnology, it's probably not what they're interested in. So how do you relate that to them? Maybe you bring an ETF, and inside the ETF, there's Apple, there's Netflix, there's Nike, there's these types of things. So
I don't mind the idea, right, of, say, when they're teenagers. So I'm thinking well ahead here, of actually maybe some individual share ownership, right? And more purely not for the return perspective, but for the lesson. And I'm thinking, like, if I had a teenager now, I'm sure parents of teenagers would tell me this is absolutely useless because they won't listen to me. But like, you might walk around town and go into JB Hi-Fi and say, hey, you own a bit of this. Like, you can say, like, talk about how JB Hi-Fi, the business, actually works, the stock, or Lavisa. So actual companies that they're interested in.
Yeah.
And they have some kind of connection with. So, like right now, if it was up to Wilbur, I know we'd be buying stock in whatever the train manufacturer is that he loves.
Lego or something like this.
Lego, or whoever makes those plastic dinosaurs at the museum.
My sister, I was messaging her this morning, Mitch. She got a dividend from the VAS ETF. So I don't know if you all can see this. This is her Pearler account. She got $700 in there. Her ETF is up. What is it? 19% since the beginning of the year, and she got a $7 dividend the other day. She said to me, she goes, I said, just so you know, you got a dividend. She said, wait, where did the money come from? And I explained the concept of a dividend, which she kind of got. And then she goes on to, I explain what an asset is and why you make money from an asset. And she said, good, I'm going to be rich. And that's basically it. I said,
job done. Rinse and repeat. Set up the DRP and away she goes.
I said to her, if she puts $25 in, I'll put 75, and she's got an extra 100 that she can invest and keep going that way. And those little lessons. Interestingly, as I was doing this morning before work, I really had to pay attention to the words that I use, the language that we use to describe things. And sometimes there's analogies that are much more relatable. If you go in with, it's got a price earnings ratio and its yield looks like this, they're going, what the hell does that mean? Like, that doesn't relate to a 14-year-old, but maybe that relates to a 21-year-old or something like that. So great stuff here. Raymond says, when is Rask going to have a brand logo launch party at Flinders Lane office? Open house. Mitch?
You can go to the Flinders Lane office whenever you like and have a party, because we have actually just moved. We're on Queen Street now, so but go and knock on the door, because Drew from Waddle Partners is still there, and I know he's actually got a little drinks trolley, so I'm sure he'll pour you a glass.
Yeah, we'll throw him under the bus. That's perfect. I like it. Sorry, Drew. Two key points or three key points I wanted to highlight for anyone that's managing their own portfolio. So how we're thinking about it, this might help you. So you can see on the screen in front of you, this is inflation. This is Australian inflation. And crucially, we talked about this on the live show last week. Australian inflation is coming back to what the Reserve Bank would call its target band, which is 2 to 3%. And what that basically means is that as that continues to happen, we would likely see downwards pressure on interest rates. But every time, I want to stress this, every time there is a change in these type of macroeconomic variables, you can make money. A lot of people think that it's buy or sell, as in, I'm going to sell out of that and I'm going to put it in cash. But that is actually a decision. Cash will work better for you in certain environments. And this is the old cliche that money has to go somewhere. And so wherever you put your money, you can use some of these indicators just to improve your overall return. So a good example of this will be, as interest rates begin to fall, you might start to consider other things like, I don't know, property or infrastructure. And the reason why is they'll pay you a slightly higher amount of return as interest rates fall than, say, a term deposit, because they'll add inflation onto their rental increases every year. And so eventually it starts to compound faster than your cash. And so you might see that happen. Another thing, if you look in our portfolios, and many of us listening will, even if you don't invest with us, you probably have the same problem, is that you have a bit of cash. So you have cash, particularly if you're a retiree, you'll have a lot of cash. So if I was out there right now and I was a retiree and I have a big part of my wealth in cash, start locking in some term deposits, not all in one go, different maturities, maybe a few different banks. Start locking in term deposits soon, because the downside of doing that, like the risk of making that decision, is that interest rates somehow keep going up and you don't get as good of a return. which is not good for you. But the upside is that interest rates do fall over the next few years and you've locked in a good rate. So consider locking in some of your rate. Now, if you don't have that ability, like you've got an ETF, you can buy a bond ETF still. There is opportunity to buy a bond ETF now, and you will get good income, plus you will benefit as interest rates are continued to fall. So that's why I've said here that as interest rates fall, our bond ETFs should continue to rise. Now, that's a should, it's not a will. Key point is should. These things aren't certain. But basically what this shows you is the expectations of interest rates. We went over this with Pete last week. This is when bond ETFs start to return better returns. The difference between a bond ETF and a cash ETF or a term deposit is that a bond ETF can increase in value as well, or decrease. It can increase and decrease in value. A term deposit will not increase or decrease in value. It will just pay you the set amount of income. So I hope that makes sense. Now, Claire's mentioned something, which is a REIT. You could use a REIT in your portfolio. So we can consider REITs as part of our portfolios, and that's something we will be probably considering over the next 6 months, as well as infrastructure. So there's like IFRA, IFRA. There's VBuild, VBLD. These are the common ETFs that people would use. There's a lot of ETFs, but we'll keep you up to date. Obviously, if you invest with us, you'll know straight away anyway, but we'll keep you up to date as that evolves. Another tricky question we're getting from people who don't know how to manage this aspect in their portfolio is, when do we currency hedge? When do we pick the ETF that neutralizes the US dollar movement? We at Rask have got a very, little bit of our portfolio currency hedge. So if you go back, you can see that here with the IHVV ETF. So that's throughout all of our portfolios. And in particular, I want to call this one out here, which is our high growth portfolio. We've got about 40% in the US stock market, and about 10% of that is in the hedged version and 30% is unhedged. Now, we could probably afford to have a little bit more in currency hedged. If you're in retirement, obviously there's no tax consequence from just switching to one to the other. If it's in your super, no tax, basically. If you're an accumulator like Mitch and I, we're working, we're paying taxes and all that sort of stuff, you can't just up and switch because you'll pay tax and there's a lot of cost involved in switching ETFs around. So you kind of want to stick with a level of it and then just try and add to the other one to try and bring your portfolio into a view or a balance that you have. Like, we get a lot of questions like, should I sell this ETF and go to that one? Well, if you do that, the first thing you're going to do is have to pay tax, in which case you're going to have to try and work your way back up to that level before it makes sense. So maybe an alternative to that is you've got your portfolio looking like this and you want it to look like this, is maybe over time you start with a new portfolio, quote unquote new portfolio, and you slowly build it across to that, not all at once. And then you kind of think about, well, I can just slowly add to this and I'll be okay. Like, a good example of this is if you own A200 from BetaShares, because it's the lowest cost top 200 Aussie shares ETF, and you think, oh, I want to switch to STW for whatever reason, or IOZ or VAS, don't just up and sell A200 for the sake of it. It's virtually the same ETF. You could just build the other one side by side. You're going to get exactly the same return, or very close to, over time. So that's that. Now, okay. So yeah, succinct. You did say maybe for most teens, but there may be a few 14 or 15-year-olds that would love the yield, dividend, etc. Yeah. So my sister absolutely loves the dividend. She just didn't understand the lingo. So she loves the dividend and the idea of passive income and money while you sleep. But I say money while you sleep or passive income. I don't say yield. The reason why, she doesn't understand what yield means yet. The yield might sound like something she sees in the farms as she drives to school, or so, I don't know, something like that. But she doesn't understand that lingo. So it's more the terminology. Now, when she's 2 years into this investing journey with me, then I'll start to use terms like yield and I'll introduce her to the jargon. But just being really deliberate about the phrases and the words you use is just really, really important. Now, we do have a couple of topics that we want to talk about. I just want to quickly touch on something. We had this gentleman, his name's Scott Bennett, in the studio yesterday here in Melbourne. And he's a fantastic thinker and speaker and investor when it comes to using systematic trading and technology-driven trading. So what I mean by that is he invests in Australian small and medium-sized companies, but they don't use a stock picking methodology. They don't use I go and like this stock, oh, I like that product, I'll buy that company. It's all systematic, meaning that they use factors, they use tools and data to make their decisions. Systematic trading is what it is. I asked him the exact question that Mitch and I wanted to talk about. Does AI make you a better investor? And he said, which is very, very interesting, he said that it's not the answer that's important, it's how you got to it. So unless you can use AI in a way to help you understand how you got to it, it may not be an advantage at all. It may be a disadvantage. So Mitch, I'm curious, do you think AI can make you a better investor? Maybe yes, maybe no.
Are we going to say personally?
Sure.
Because I don't think I'm very good at using AI. I haven't jumped into it as much as a lot of other people. I do have a ChatGPT tab open in front of me, but I'm hearing about ways that other people are using it that are fantastic. And I think that's really interesting, Owen. And I think if you are, say, an individual stock picker, right? Is it going to help you if you're investing in ETFs like IVV and VAS, etc.? I can't see how it's going to make you better because your one job as an investor in those ETFs is just to hold. That's it. Like your one job, if you're is hold and occasionally rebalance. But if you're an individual stock picker, I think, and I spend my time thinking about this a lot. Have you ever sat there and thought to yourself that you wish you could ask better questions? Like
we both host people on podcasts, Mitch. So I think about this probably a disproportionate amount.
I think about it a lot. Like if you want a better answer, ask a better question. And I think if you're an individual stock picker, for me, I would probably use it in that approach of what haven't I asked? What haven't I thought of? And use it like that. But I'm an absolute novice when it comes to AI. How do you think, Owen? Because I know you use it a lot. Like you use it a lot more than I do, and you're a lot more switched on with it.
Well, thank you. I don't know about that, but I was building algorithms for not AI, but I was building algorithms for investing and for research 6 to 8 years ago. And we don't need to go into that today, but basically the writing was on the wall that you could use these types of tools to do the repetitious stuff in investing, like instantly. You could, you want to get a company profile with fundamental data, profit margins, stuff like that, instant. You want to score a company through your checklist, instantly done. You just put in the ticker symbol, pick a stock, done. The key thing with that is that there's two parts of this. One, you need really good data. That's what's really important, because if you feed it just rubbish, it's going to bring you back rubbish. And the second thing is, like you said, you've got to know how to use the tool and its limitations. And Scott said something really interesting. He said the original genesis, I didn't know this, but I made sense to me. He said the original genesis of the current AI suite of tools was that Google wanted to use a system to determine images and what was in the image. So if you knew the difference between a cat and a dog, could you determine that like with a code, basically, rather than a human? Like a human can instantly determine that. But what they found was that it was almost impossible for the code to determine the difference between a dog and a wolf. So we could determine the difference. Like you and I could look and say, that's a Groodle, that's a wolf. Like it's a bit different, right? And over time, what they did is that they fed it more and more images. And what they found was that eventually the AI could determine what was a dog and what was a wolf, right? But the key thing was that when they found in the code why it determined what was a dog and what was a wolf, what they found is that it all came down to the background. On average, the wolf photos had snow behind them. And it was the snow which determined whether it was a dog or a wolf.
What did the Groodle have behind it?
Yeah. It was upside down with a cushion. but that was the point. So like, and you and I would experience it too. Like if we were to sit down and look at a photo of a wolf and a dog grab a side, we would be able to identify it. But if we began describing it to each other, we'd say, oh, it's got kind of pointed ears, it's got sharp teeth, and that's what an algorithm takes as the data input. And so when it comes to investing, a lot of people are using these tools, and I think they're trying to find an answer when what they really need to know is why does it get to that answer. And it's like when I do a valuation of a company and I do a discounted cash flow analysis, the value doesn't come from knowing what the valuation is. The true value of valuation is going through the process to understand if you change something within a business, what impact does that have on the rest of the cash flow, on the rest of the profitability, on all of these types of things? Claire asked a good question. What other AI tools outside of ChatGPT? I've only just started using it. Now, we're just talking in the pure context of investing, Claire. For just general purpose use, things like Gemini are really cool. We've started experimenting here with Rask as part of our rebrand. Our designer, Sophie, she's got a hold of this tool where you can put in a photo, like say of Mitch and I here. Mitch is in his white t-shirt, I'm in my gray t-shirt. Take one photo of us, and then let's say you want to look like you've got a suit on and you're presentable. The AI will put you in that suit, which is quite incredible.
So this tool could probably give me a shave too.
Probably could. Matthew says AI is great to pass large amounts of data and reduce it to stuff humans can use easier. They suck at picking. That's so true, Matthew. So one of the examples of this is when we pick ETFs for our investment portfolios or fund managers and that sort of stuff to go in the portfolios. As Mitch said before, you want to know how two different funds or two different investments relate to each other. Like if you invest in the Magellan Global Fund and the IVV ETF, one's an ETF, one's a fund manager. But because they both invest in technology companies, they're both going to move a little bit in the same direction, right? So this is the type of analysis an analyst would do. And so when I did that using ChatGPT 4, it came back with answers that were just stupendously incorrect. And then I said, no, like, where are you getting your data from? So I asked it that question and it gave me, and I said, try using this other piece of data and do the calculation again. And then it came back with an even more incorrect answer. And so unless you're really paying attention, it's great at bringing data together, but how it actually relates to each other, I think that's the point that's missing.
I think as well, there's going to be the people who maybe get the most out of this are those who combine that power of it, because it'll just become commoditized. Really, the power of it with boots on the ground research. There's a fantastic story that Andrew Mitchell from Ophir Asset Management tells. And I interviewed Andrew Mitchell a couple of years ago, and he tells this wonderful story about how he made a very good investment in A2 Milk. It wasn't based on going over the numbers and whatnot. They got out of the office and they went to numerous supermarkets and just got a tin of A2 Milk and looked at it and said, well, is there any clues on this product that could help us out? And by doing that, they noticed that there was a manufactured date on the tin. And so from that moment on, every week they would go to numerous supermarkets and they would start tracking the manufactured date on the tins of A2 Milk. And then they noticed a trend as they were charting the dates, that the dates were getting shorter and shorter and shorter, meaning that they were producing more and more and more and more A2 Milk, and they were selling more. And that went into their thesis that they should be buying A2 Milk and also then shorting, potentially shorting Bellamy's, which I found was really, which was a very, very smart play in the end. The market proved that to be correct. So I still think if you cannot replace that boots on the ground, that kind of style, like investigation for analysis. But anyway.
I agree. So Mitch, before your time, this was about this time last year, I was over in Adelaide with the Rask crew, and there was about 150, 160 of us at this wonderful spot in the Adelaide CBD. And we had some really good thought-provoking questions.
Andrew Mitchell is an Adelaide boy from memory.
Maybe there's something in the
he
sort.
is. Yeah, he's from Adelaide.
And we had some really good engaging questions, but we also had a lady that was very, 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 very pessimistic about the future of AI. And I accidentally gave her the microphone to ask a question.
You never hand over the microphone. That's amateur hour.
And let's just say things got a little bit out of control because she was convinced that this robot, which is called Sophia, was invading the UN because the robot appeared at the UN, and she was convinced that this robot was going to take over the world. And therefore, what were the implications for investing? Bless her soul. Obviously, that hasn't happened. But the key thing is there's a lot of hysteria around AI. And if we just relate it to investing for a moment, this is my belief, and I'm going to stick with it until proven otherwise, which is that one, AI won't make you a better investor. It might give you answers, but it won't make you a better investor because it won't tell you when to hold on why and these types of things. Second of all, humans are the ones that make purchasing decisions. So in your instance, you mentioned, infant formula. So long as humans are the ones that are buying the products and services that people and companies are selling, that will mean that it's going to be a human that is ultimately going to be rational. It's not making a decision in a spreadsheet. And you will be able to, as an investor, identify what things are becoming interesting to other humans, and you will be able to still have some type of advantage. Now, some of the things are clearly not going to add value. So things like, for example, trying to pick the lowest PE ratio, or the company that's going to have, a dividend payment in 3 months. If that's your strategy, you're against the robots. You're not going to win. But if your strategy is more human-centered, you're probably going to win. And you, as Graham just said here, you can use these tools to your advantage by making what you already do better. But if you're trying to go into a field where you're going to try and out-calculate the robot, you're not going to win. And so that's my 2 cents, and happy to be disproven on that because let me know. I'd rather just find the answer and make money from it than trying to be right. So
personally as well, I don't know about people watching this, but I'm kind of skipping over podcasts now that are AI heavy. I'm a bit overdone.
Yeah, it's like all the same podcasts that are talking about AI now were the same podcasts talking about the blockchain and crypto 3 years ago, and before that they were talking about cannabis.
Before that, they were talking about 3D printing.
Yeah, right. And so, these are quite interesting. Yeah. So Graham also says that AI can help you identify candidates for a much bigger universe. Yeah. So these are the types of tools where it increases productivity, Graham. So I agree completely. Productivity, and that's why they're going to be so powerful for businesses and for people that work in white-collar jobs. For other things like actual investment decision-making, and I just don't see the application now. So if we come back to the other side, we've only got probably another 5 to 10 minutes. Feel free to chuck your questions in the...
We've waffled a lot today.
There are a couple more questions here. I'll be quick maybe with this one, and then we'll move on to the other one, which is how often should I invest? What we find is that most people are investing every month, and the data suggests that whatever you can, the most important thing is just add regularly.
Yeah.
People freak out about how much and whatever. Just invest. That's the most important thing.
Just do it. That's number one. If you are doing it and you want to do it a little bit better, I know at Rask Invest, there's been a bit of conversation between myself and a few other investors recently, and they're actually now timing it. Say for the ETFs we hold, they predominantly pay quarterly distributions. Mm-hmm. One pays monthly, but it's a minuscule amount. And so what they're actually doing is adding their contribution at the start of that of the following month after the quarterly distributions have been paid. So the quarterly distributions, the cash there gets sucked up with their contribution, and in the one purchases the next lot of ETFs. So people are doing that, and they're actually using a recurring BPay payment to do it. So it's kind of automated a bit at their end. So I'm seeing that more and more a lot recently. So I'm actually seeing the regular contribution plan people where we pull money from your account every single month. I'm seeing that decrease actually in the number of people using it because people are switching to the recurring BPay payment.
So that's really important to understand. Just for people's context, we automatically invest your cash once it gets to a certain limit. Whereas if you don't have a platform or whatever that does that, you have to do that manually. And if that's the case, you still want to be actively investing. So you still want to be actively putting money to work as often as you can. The lower your brokerage, the lower your amount that basically you can put in. Now we have set limits where we won't invest under $250, Mitch. Yeah. So we won't invest unless it's over that to make sure that you're getting cost efficiency. But for most people, the answer is just invest as often as you can because that's what the data shows. One final question here, and then we'll go to the chat real quick. What was the money coach? At what point should you use a money coach? Mitch, anything to add on this?
I'm starting to see a lot of people who have kind of broad questions about structuring their personal finances and whatnot. And so they're on the cusp in between of, hey, do I need a money coach? But they want someone to sit down and tell them and structure things for them. So they're on the cusp of, hey, do I need a financial advisor or do I need a money coach? Money coaches, of course, are a lot cheaper than financial advisors. What would you say, Owen? Because I'm kind of new to the realm of money coaches.
Yeah, so in Australia, money coaches are a different type of, I guess, profession. So let's just explain what it is. If you have someone who is retirement planning and needs to know which super funds and how to do all that stuff, that is financial advice. You need a financial advisor to help you with that. But let's say you want someone that's more like a personal trainer. So someone that is helping you stay on track with your goals, helping you manage your cash flow and do budgeting and that sort of stuff. And you want to, maybe you want to save for a house and you just need someone to say, how can I create a budget that works for me? How can I create a money system, put things on autopilot? Or even things like, say, for example, like life events like, hey, my partner has a terminal illness. I've just been through a divorce. I'm in a new relationship and my partner won't talk to me about money. These are the areas where a money coach is amazing because you don't have to pay thousands and thousands of dollars to see a financial advisor. You might pay a few $100 to see a money coach, but you won't pay thousands. So a couple of quick tips. Number one, find a money coach with experience, like they've actually done a degree or they've actually been a financial advisor before. You'll get a much better service from that. Find someone who you connect with. Just see if you can jump on a free discovery call. And just make sure that you understand that they can't tell you what investments to make. They can't tell you which super fund is right for you because that's financial advice. But they can help you with the other parts of your life. So I think, it's an emerging profession. I think obviously just use someone that's experienced, but it's a really interesting thing. And I'm glad it's coming more alive in Australia. Okay, so we do have quite a few questions. Graham said, interview a fundie using AI. So Graham, that image that I just showed on the screen before of Scott Bennett, he's from Invesco. That's coming up on the Australian Investors podcast in 2 weeks. So we talk about AI, we talk about technology, we talk about systematic trading, which is kind of what you're talking about, Graham. That's on the Investors podcast in 2 weeks. So that's the yellow one, although it might be a slightly different color in 2 weeks' time. But that's the Australian Investors podcast, mate. Okay, so Official Pender says, using brokerage platforms, ComSec, investing ETFs, CMC over the long term. CMC provides no brokerage under $1,000. ComSec charges $2. The key thing for me, Official Penders, is we can't tell you what to do. So we can't tell you which platform to use. I'm going to share something in the chat. Rask stock platforms or something. It is 2024. I'll just pop something in the chat and it will allow you to understand the different things. This is a show, if anyone wants to help me out here, because I can't respond to this and Mitch can't tell anyone what to do. Does anyone want to just say what brokerage account you use and just chuck it in the chat? You don't have, there's not a recommendation. Just chuck it in the chat. I'd be interested to know. So here what are the other things? We've got, if I buy a stock, this is from My World, which does not pay dividends using an investment loan. Okay, so what you're referring to, you said it, can I claim the interest as a tax deduction? This is a very gray area, my world. So what you're referring to is using an investment loan on debt recycling, equity release, investment loans. I would speak to your accountant because the answer is it depends. In particular, with this, you want to make sure that there's a connection between earning income and claiming a tax deduction for the interest, because the ATO would use words like there must be a sufficient nexus, meaning that they must have some purpose. Speak to your accountant because they may be able to word that slightly differently, and it may depend on other things like how often you're buying and selling. These types of things, if you feel my drift. So go and speak to a good accountant on that. Webull, Perla, Vanguard, Stake, Beta Shares Direct, Vanguard, ComSec as well, Self Wealth, so many good brokers in here. My World, when is the satellite portfolio coming live in Rask? That's on, you know how we said, you might not have been here for this, My World, but at the top of the show, we said there's things that we want to get done in the next 6 to 9 months. This is at the top of our list as well. So it's kids, and there's probably this, to be honest, at the top of our list. So next 6 to 9 months, we've got a big product roadmap. That's on that list. Mitch, what do you use for buying shares?
I've got a great big fat whopping mortgage. So look, my investing is pretty limited these days. I've got a big investment portfolio right here in Brunswick. No, but I historically I've bounced around. I still actually day to day log into my old ComSec account because I've got so many watch lists on there, and I find it, because I'm so used to it, I find it really easy to get around. I've not traded on ComSec for a very long time. I've used CMC when I set up my son's account originally to invest for him. I used CMC purely because trades, you get one trade under $1,000 for zero brokerage. So for me, it was incredibly important to keep costs low and have a HIN. So generally speaking, if you're paying absolutely bugger all in brokerage, you might not be on a HIN model. It might be a custodian model. For me, HIN model was just so much easier for the portability. I know from personal experience of transferring a lot of stocks over my X amount of years in the industry. I do in specie and off market transfers all the time for people coming into different investment services. Custodian models can do transfers, but from the experience of the person doing it, it's a lot harder.
Yeah,
it's a lot harder. It can take a long time. But where a HIN to HIN is far easier. So that was important for me. And I've recently opened up a just so I can get in there and experience it, because we do so much work with these people, and I actually really enjoy working with them. I've opened up a Perla account because I don't know. I these days I align my services and whatnot with people that I actually really enjoy dealing with. Hence why I've opened the Perla account, because they're just a pleasure. And I've got the Pocketsmith account as well, because I literally have not met a nicer bunch of people. So I want to do business with them.
Yeah, that's good. I think as you get older, you get a bit more, I guess, discerning about the people that you deal with. And I think we're at a point now with the industry where cheapest is no longer best. I think
it was a fantastic, your interview, if you remember, with Nick from Perla. He said price now is no longer a feature.
Yeah.
Cheap is no longer a competitive advantage, because everyone's cheap. What's the difference between $3 brokerage and $4 brokerage? That is not what's going to get you more clientele.
I just popped it in the chat for anyone that's interested, this conversation with Nick. So full disclosure, Perla is a long-term supporter of our podcast, and also Beta Shares, who has the Beta Shares Direct platform, is also a supporter of our podcast. So just for full disclosure, don't get anything to say that. But it's really interesting. I think a lot of people here, like RBT, saying ComSec, interactive brokers. My World uses interactive brokers as well. Jenny saying, this is interesting, Jenny. You said that you use self-wealth after having a specialist broker. Much happier doing it myself. A lot of people are now still transitioning away from going to see someone or getting on the phone with a broker and actually just doing it yourself, because you save money. And Claire said something funny here, which they use Target Trade and Stake. So they're running 2 online brokers, but they say, and the odd pub lunch with my broker odds.
Well, back in the day, back in the many moons ago, when I worked for a boutique fund manager, I used to transfer a lot of portfolios away from Bell Potter, Ord Minnett, etc. Those
full service brokers.
Those the older school style. Geez, I've not seen one in a long time. Now, like I've not seen one in a very long time.
I was just chatting to the team here. They were going to Customs House here in Melbourne CBD, which is it's a famous like broker hangout. But they were saying the cafe's totally changed now. It's actually good. So
I've never been.
Times have changed. So Ali did ask, if someone hypothetically has a large amount of funds invested in single stocks because they are more invested in what they own and worried if they go to an ETF they won't be invested, but at the same time though they are doing it wrong, what should they do? Yeah, so you are right, Ali. We can't tell anyone individual what to do, but I'm glad this hypothetical person may be out there. So I made this transition too. So I asked you for what broker you use, Mitch. I still own some direct stocks with ComSec. I put my sister on to Perla, and my wife Sarah has a very small shareholding, and she uses self-wealth. And obviously we have Rask Invest, which is now where we're going to just be shoveling all of our core dollars. But I think all of the platforms are good. The key thing that for me is that all of them are HIN based. You mentioned the admin difficulty. Next week on this show, we're going to talk about the nightmares that happen on Collins Street, and why we use Collins Street is because it's like Australia's equivalent of Wall Street. The reality is also, I just want the extra layer of security. If someone comes to me in 5 years and says, so Owen, we're really sorry that you lost your money. If only you paid an extra $2 with a HIN broker, I would have been like, what? Like, not to say that custodial models are fine, but if we have the option in Australia, why not just have the extra insurance? I just think for a couple of dollars.
Look, it's very rare for custodians to.
It is so
very, very, very rare. The rest of the world, it's custodian model. If you are investing in US stocks here in Australia, it's
still a custodian.
It's a custodian. So it is rare, but here in Australia, we do not have to have that. So, well,
we're obviously biased because our platform is HIN, but custodians, it's very rare that they go down ever because they're super well regulated. ETFs are custodians as well. So like, it's very rare. If you have the option, do it. If not, like you might have one broker set up for one thing and then for another do something else. And I think back to the question of transitioning away from individual stocks, I think it's just a matter of knowing what the current tax position is of any investor, whether you've got currently got ETFs, funds, investment properties, knowing what the tax position is. You can do that with ShareSite or Navexa, or you can just calculate it in a spreadsheet or get your accountant to do it. You can calculate that. Then you know what your tax position is. Are you going to be earning more or less next financial year? How do you manage that tax position? And just slowly make the migration across. Anyone transitioning to ETFs, you're not alone. Beta Shares and Investment Trends came out with a report earlier this year that said 2 million Australians now have invested in ETFs. And that number is just going to keep growing and growing and growing and growing. See, Graham, you made a good point here about Beta Shares Direct as a custodian. To be honest, Beta Shares is a wonderful business, just like Vanguard and
they would have done their due diligence, absolutely. And as I said, like it's very rare for a custodian to come into any form of trouble. They're typically like your very, very large banks and institutions like Citigroup, etc. Just historically, though, when one has come into trouble, people did not necessarily lose anything, but it did take a long time to recover, to get those assets back and be able to move away.
Yeah. And that was one of the things that happened with BBY. So BBY collapsed a few years ago. I think most of the assets were on HIN. People got their money out. That was pretty quick. If you go back a few years before that with Opus Prime, which collapsed, Some of the money was on him, and then there was a few other banks that came in and rescued it. And even the custodial dollars there, most of it was fine. So the reality is, it just, like you said, it's more a clerical thing. It's more an administrative thing. And another thing that might happen is you may be given the cash instead of the exact securities or something like that in the worst case scenario. But it's very unlikely. And ultimately, I think a lot of it comes down to what you would rather, just the platform and the features that you would like. So, Jenny, I wondered why my last broker was trading my shares so much when he accidentally dropped that he was saving to buy a house in Brighton. I left that day.
Jenny, that's a fantastic example of show me the incentive and I'll show you the behavior.
Yeah. Graham, final one for today, said, I had an Opus Prime account and fortunately dodged a bullet. So, Graham, you've got a memory. You understand. These things don't always work exactly as they should. Now, final thing for today, if you are interested in getting some tickets and you like these types of live shows, our friends at the Australian Shareholders Association, a not-for-profit that focuses on making sure companies do the right thing, is hosting its Virtual Investor Summit this time next week, so Thursday and Friday next week. I am appearing next week at around 1 p.m. on Thursday. So I'll be coming here for the live show and then going straight there to do a different session with them. And you can support them, and you can also become part of a great community if you sign up. If you're already a member, it's only $25. The $25 goes straight to the ASA. If you're a non-member, you can sign up. It's $79. It's a great session. So I'm going to put this in the chat right now. You'll see it come through. You can go and be part of the ASA, hear from some great speakers next week, next Thursday, next Friday, and just support the ASA, get involved in the community, get resources, that type of stuff. If you're already subscribed to the Rask email, there may also be some free tickets this weekend. So keep an eye out for that. But $25, our team is getting the $25 ticket. Come along. It'll be great to see you there. Next week, we will also be doing the bit of the shock and awe session. And if you want to learn more about Rask Invest, you can head to the invest.rask.com.au website. The link is in the YouTube description there. You can click the link. You can jump on the instant chat with Mitchell and I there too. Whew. Mitch, great fun.
It looks like it's pretty warm in the office, mate.
It is. That is. I'll tell you what, you close the door and you sit in here for an hour and a half, and especially after two financial planners have been here.
I think we just need to point out, Owen is not sick or unwell. It's just warm. It's in hot, that room.
I just think that it's yeah. I think when you get two financial planners talking about retirement, it just gets hot and steamy in here.
There's
a
lot of air in there.
Yeah. So I've just walked into that. But no, it's been great, mate. And thank you everyone who joined us today. Mitch will be back on Monday on the Rask YouTube channel. I'm back next Thursday. It's always a pleasure. Bring your questions, jump into the Rask community. We love hearing from you. And if you're invested with us, thank you for your support. It means the world to us. So thank you so much.
Awesome.
Mitch,
Thanks,
pleasure,
Owen.
mate. Cheers, mate.
Guys.
Thank you, everyone.